Hi, viewers. Thanks for joining me. My name is Martin Caballero. I'm the managing editor at BevNET.com. I am broadcasting here from my home office just outside Boston, and we are continuing our ongoing coverage of the COVID-19 pandemic and its effect on the food and beverage industry. Today, I'm really excited because we have with us Jeremy Halpern, who's a partner at Boston-based law firm Nutter. He's also the co-chair of the Merchant Companies Group and co-chair of the food and beverage team at Nutter. He's lots of experience in corporate financing, mergers and acquisitions, and he's going to be talking a little bit about how the COVID-19 pandemic is affecting lending and capital markets for food and beverage companies specifically. So first of all, Jeremy, thank you so much for joining us, and how are you doing?
Thank you for asking me to participate, and I hope you and the whole BevNet and Nosh teams are doing well.
There's obviously a lot to get into here, but first of all, just on a macro level, how is the COVID-19 pandemic impacting the status of lending and capital available to food and beverage companies right now?
Sure. So, it's as everyone knows, it's a very turbulent time. There's a lot of pressure happening on both the debt and the equity side. I think a lot of the listeners might be aware of all of the changes at both the federal and state, and in some cases local levels about lending availability for small businesses or folks that qualify as a small business under either the SBA program or under their local economic development requirements. A lot of capital is flowing into the system as a consequence. Some of it is specifically aimed at payroll. Some of it is still aimed at more general long-term working capital issues, as well as build-out and capacity issues. So there's a lot of money supply flowing in to backstop these companies, as many of them have taken substantial revenue hits, or there's a lot of revenue uncertainty. On the more traditional lending, we haven't seen a lot of change right now. So folks who had existing working capital lines, those still seem to be going, subject to the idea that if there is compression on their covenants, on their ratios, or the supply of AR that they've got, then that's obviously compromising the amount of capital that they can draw down into those facilities. So we think right now that the more general lending is relatively stable for the moment, but that lending isn't going to protect people against substantial losses in anticipated revenue, and that's where those other programs are stepping in. On the investment side, on the angel venture or private equity strategic investment side, we've seen a big set of changes already, and we anticipate actually a lot more change to come over the coming couple of quarters. As you might expect, we think, going to be quite a lot of pressure on the quantity of money supply. And as supply flows out of the system, the prices for companies may deteriorate, meaning the valuation at which entrepreneurs are raising money is going to go down. The ability of them to raise money is going to get compromised. And for a lot of folks who were counting on a certain percentage likelihood of money showing up at particular times in their life cycle, I think a lot of them are going to face some tough times as those investors don't show up at the originally anticipated time. So they're going to have to bridge gaps and extend runways.
And just to follow up on that, how are you observing different investors, be it angel investors, private equity firms, or others, approaching investing during this time? How are their attitudes different?
Sure. There's going to be a bunch of change, and some of it's, I think, pretty obvious, and some of it's less obvious. For individual angels, part of the problem that I think people understand is that as the economy has taken a big hit, as the stock market has taken a big hit, individual angels' personal liquidity has been compromised. And so people who were sitting on X amount of cash are sitting on less than X amount of cash now. And so their willingness to part with that for high-risk ventures is going to go down on aggregate. There's, I think, no question about that. The less obvious is for people who consider themselves professional angel investors, meaning they're trying to build a portfolio of 10 to 20, 30 companies that they're invested in. They think of that portfolio as a subset of a broader portfolio of all of their investing activity. And the angel portfolio is usually pegged somewhere in the 10 to 15% of their total investable portfolio. And so because those investments are held at their cost basis, if I've put $1 million in and I had a $10 million portfolio and that was 10%, or maybe I put in $500,000, that was only 5%, I was going to invest another $500,000 to make it to 10%. if the rest of my portfolio is down $2, $3, $4 million, then I'm over allocated in my private investing. And so I, the individual angel, might choose not to make an investment, not because I don't have cash. I may have cash, but I'm putting that into other areas based on a broader portfolio asset allocation strategy. So that's going to reduce in supply. For the smaller VCs, they're in a bit of a pickle. They have a fiduciary obligation to invest the capital that they've raised from their limited partners. So the people who have existing funds who are in year 3 or 4 of that fund still need to put that money to work, and so they're going to put some they're going to put that money to work in deals. The question is, do they put that to work in new deals, or do they put that to work more in follow-on deals into their existing companies? And we think they're going to take a much harder look at their risk profile at this moment, and may choose to support existing projects rather than put it into new projects. For much bigger funds, that pressure may be alleviated somewhat, but my guess is that you're going to see some similar effects. For funds that are at the earlier part of their life cycle, if they just raised money in the last year or so, you could imagine that they're going to sit on new deals for probably the next 4 to 6 months while they understand what the full implications of the crisis are. And so that will take a lot of money out of the system very rapidly. And then I think one big issue for long-term effects is as those funds are in their, let's say, the last couple of years in which they would be investing, and they start to think about raising the next fund. So maybe they're in fund cycle, they're year 3, year 4, year 5. That's a big issue because the limited partners are very likely to scale back. And if they can't raise new funds, what it means for projects that were invested last year, 2019 in particular, and people were counting on being able to put in the next tranche of money in 2020 from Fund 2 or whatever it might be. That money may not be there. A lot of the venture funds may be unable to raise sufficient capital going forward, at least for the next year or so. And so that's going to create a lot of unanticipated effects. And brands should be knowledgeable about where they sit in their existing venture investors' fund cycle. What's happening with that fund? They should be communicating back and forth about that. For folks who have yet to get investment, that's going to mean there's pretty severe pressure from a lot of those to raise that money while there's any money available, because we could really go into a dry period. At the farther end of the spectrum, at the private equity side, we think that they actually may go on a bit of a buying spree, but it's not going to be a buying spree that any entrepreneur is going to be very excited about, because most of those investors, I think, will put money to work at very discounted prices, and you will see very opportunistic acquisitions happening from private equity players. So it wouldn't shock me at all if you start to see transactions where the multiples are much lower than they have been over the last 5 years, and more in line with where things were traditionally in the private equity market, as well as brands that are, again, they're going back to focusing on $5 million plus positive EBITDA brands as opposed to barely break even or even cash flow negative brands. So there's going to be, I think, a lot of concern by entrepreneurs and by investors as they struggle with trying to look down the road 12, 24 months.
There's a couple of points I'd love to follow up on there, but in terms of trying to understand how investors are thinking right now, both in the short and long term, where's the most attention being paid?
From the investors, most of them are just going into kind of crisis management mode. So a lot of the brands we work with, all of their venture investors have reached out and said, what's happening? How is the business performing? What is the impact? How is this going to change cash flow? How is this going to change cash needs for the business? Meaning, what's your runway? When is the thing going to fly into the mountain if we don't find more money? So they're spending a lot of their time trying to manage the current portfolio, and that just takes time away from doing new deal prospecting or even supporting those existing brands and trying to find exit possibilities. So shift in attention, shift in time, shift in priority, I think, is happening for a lot of those existing investors.
Now, Jeremy, you mentioned that we might be seeing some of the multiples from previous years come down quite a bit. Could you talk a little bit about how this crisis is affecting round pricing? And should companies be thinking about taking as much capital as possible in exchange for the dilution that comes with that? Or should they still be trying to protect against that if possible?
Yeah, so right, the tension here is as a brand in a perfect world, you are raising money at each step of valuation increase, right? So you're always going up and to the right. And the result of that is you're reducing the total quantity of dilution for a given amount of cash, right? So we're raising 2 million when it's a $4 or $5 million valuation, and then we're going to go raise 5, 6, 7 million when it's a $20 million valuation, and then we're going to go raise 15 million when it's a $30 million valuation. If you raise more of that up front, you get much more massively diluted as an entrepreneur, which can have real consequences. But there's an old saying in investing, which is no company fails for dilution, and lots of companies fail for running out of cash. And so, the people who are best positioned are folks who raised in December, January, February, who raised at the highest point we've ever seen from a valuation perspective and where there was a lot of money supply. And so they raised big chunks of money, and they're going to be set probably through the period of the crisis, although they may have to change the way they deploy that capital. The brands that are in big trouble are the brands who were thinking about raising in March, April, May, June, July, who probably aren't going to raise that money unless they were in relatively unique circumstances or things were going very positively across the board. And it's a strange thing because some of the brands, for those who are watching this who are in shelf-stable products, some of those products are having their best quarter ever. Some of them are completely out of stock. They've been pulled off the shelf at such a clip. And so that seems like it's a good thing. But what investors are thinking about is, what does the supply chain look like a month from now, 2 months from now? Can you actually restore inventory? Is there a factory who's willing to put personnel to work, and can you get the raw materials? And we're seeing a lot of businesses who have sold through their inventory but now can't produce. And so that's going to be a lot of that tension. For the brands that can sort out supply chain and can give investors confidence and rely on that, that uptick, and then maybe use of that uptick in sales velocity to show additional long-term traction, engagement with those consumers, social media engagement, repurchase data, anything that's showing that these folks have actually become brand loyal, then it's actually a very interesting opportunity for those brands to tell a story to investors during this crisis moment. But for a lot of others who are early, if you're a sub $2 million brand, this is going to be an incredibly challenging time. What we don't know, and people smarter than me can talk about, are, what is this going to mean for new authorizations? Can you get on shelf if you were planning to get on shelf but hadn't yet? If you don't have distribution lined up, can you get distribution? A lot of those are going to be incredible challenges, and a lot of that will compromise models that were built based on a best of times scenario. And now we're not in the best of times, so people are going to have to really rethink their cash projections and their sales projections over the coming 12 months.
Now, for brands, how should they be integrating or addressing this current situation in their conversations with investors? And how should they be letting them know that they have integrated and thought about this when they sit down to negotiate?
All venture investing is the tension between greed and fear, right? It's the, hey, investor, if you get into this thing, we can be on a rocket ship together. We can be the next unicorn company that's going to, really outperform the market. That's what the venture investor is looking for. The fear is all the things that can get in the way of that can go wrong. And right now, there's an awful lot that is going wrong and can go wrong. And so the more a brand can help articulate for an investor each of those risks, product development, supply chain, team, marketing execution, sales distribution, how are they going to predict velocity in a chaotic environment? All of these things are going to play into a brand's ability to tell a venture investor, maybe this is actually a remarkable opportunity despite the terrible reasons for it and the terrible consequences of the pandemic. Notwithstanding, for the brand, it may prove a real blessing in the sense of opportunities to be disruptive in an environment where maybe they couldn't have been relative to other things that were happening. So brands need to do a really good job of trying to help an investor understand what are the risks and how are those risks being managed, and can you see opportunity in chaos? And that sounds a little mercenary, but that is in fact what you're trying to do in a situation like this, which is, maximize the environment that you're in. You can't control that environment. So what do you do about it? And giving them some insight about what the future might hold.
Speaking of controlling the environment, on the other side, for investors, because of the situation, are investors looking to include more downside protection to agreements in this climate? And what does the other side of the negotiating table look like?
Sure, it's too early to tell quite yet. But if we took, I was around for the 2001 crash and the 2007 crash, so I've seen what happens in the venture markets in these environments. And what typically happens is valuations come down, liquidation preferences go up. Think features in deals like participation and other things that really change the downside economics of a deal start to reappear. I remember doing a deal post 2001 that was a 10x liquidation preference. It was just a Hail Mary, right? The existing stakeholders were saying there's no value in the equity today unless this company really reaches $1 billion. In this market, I would expect to see a lot of those investors saying, gee, we can't predict what's going to happen long term out of this crisis. Are retailers going to go out of business? Are distributors going to go out of business? Are acquirers going to change their behavior? So right now we need to think not about the $1 billion exit. We need to think about, can we return to our investors their anticipated returns if we get to a $50 million exit, and to start to aim with that as a much bigger piece of their thought process. And so I would expect to see lowering of the valuations, those changes in deal terms. I'd also expect to see changes in structure, and we're starting to already see that. We're working with a couple clients now who had equity deals on the table where the investor has said, I'd rather do this as a convertible note right now. That gives me more protection as an investor, more opportunity to control what happens to my money at the end of the day. And so that's not good news for the brands. That's going to have some long-term consequences for them. Presents a lot of risk for them that they're going to need to outperform those mechanisms that are consuming value. They're consuming equity and consuming dollars, kind of pre-money dollars, and those interest effects, those discount effects, those capping effects. All of that means the brand really needs to accelerate exactly in the moment where the brand is very concerned about whether it can scale at an extreme high growth clip. And so that's going to be a big tension, I think, over the next 90 to 180 days.
Is there going to be particular attention or scrutiny on those deals for certain categories which may be experiencing more disruption right now, such as refrigerated beverages or frozen food?
Yeah, absolutely. Anything that's short shelf life, I think, is in big trouble. Frozen is in big trouble. If you walk down your grocery aisle right now, assuming you can even get into a grocery, 40% of the frozen, 50% of the frozen aisle is empty. Their supply chain challenges are enormously complicated right now, and it's not clear how fast that's going to change. So, those kind of categories, things like fresh anything, very difficult right now. Even brands that had shelf-stable product that were relying on a big DTC component are experiencing a problem because, well, you would think, oh, great, this is a perfect time to be shipping DTC. A lot of them are relying on institutional infrastructure who have bigger fish to fry. So, yes, you can get delivered by Amazon, but it may be 3 weeks later than you think it would normally be. And that can have real consequences for those brands, both from a customer satisfaction standpoint, from a cash flow standpoint, if they're carrying that inventory across, right, until, for any reason, if they're not getting paid up front before the delivery. So we're seeing, I'd say, a lot of change that is going to be worse for some kinds of categories and better for others. Some of our, pasta companies, shelf-stable beverage, food for kids, those are all doing phenomenally right now, and it's not clear that that's going to stop anytime, at least again in the next quarter.
Now, how is the situation affecting scoring receivables? How is this impacting financial health up and down the distribution chain?
Yeah, we think for folks who are, for D2C, you're typically paid up front, so you don't have an AR scoring issue. For folks who are with smaller distributors, that's going to be an interesting question. Is there concern about those distributors either paying at all or paying late, and what does that mean for the health of that accounts receivable? And does that play into what's happening with their existing working capital lines? Is that going to put pressure on those lines about what their ratios look like? The folks who have the biggest concern, I think, are folks who are shipping direct to retail or to large retail chains or anything like that, where retail is having probably bearing one of the worst brunts of this whole problem from a business perspective, right? So if you were previously selling product to a 200 store multi-unit retailer and suddenly not clear that they're buying anything or not clear that they're paying their bills, that's pretty scary if you're the brand. And so again, it's going to be different for those different distribution paths. People are going to experience, I think, very different kinds of effects from the creditworthiness, not for themselves, but the creditworthiness of their downstream distributors and end retailers.
Now, Jeremy, you talked a minute ago about convertible debt. Is that something that we're going to see take a more prominent role in this current landscape? And it was risky before, but is it even riskier now for entrepreneurs who choose to go that route?
Yeah, there's a lot of misconceptions about this, and we publish some things. So if folks haven't gone to the Nutter.com website or the Food and Beverage Team's website, please do, because there's general information people should be aware of, but it's only exacerbated by the current situation. And that is, people think about convertible notes as a way to reduce dilution. And as it turns out, a lot of those deals can actually make it worse, not better. The upshot is lower transaction costs and quicker speed. So oftentimes you can get a convertible debt deal done, within a week. You can get it done for very little in the way of legal cost. Those are good things from a brand's perspective. The problem is that what they think they're doing by engaging in these debt transactions ends up actually costing them long term. And there's both obvious structural effects, and then there's downstream things they don't see coming where they get kind of hit with a baseball bat. So the first thing that happens is, if you're doing it as a note, you're agreeing to interest and you're agreeing typically to a discount to the next round. And so you have to be performing at a higher rate of growth than that interest and discount is happening to you. Number two, in a lot of cases, people are giving caps, which say, this investment's going to price in to equity at no greater than X value. And that's problematic in a lot of cases. In an up market, it's actually more problematic because it means you could go get a new investor to say, I'm coming in at a $6 million price, and old investors are effectively converting their debt investment, the value of the principal and interest, at a $3 million price. So that can create kind of a three-way tension, as well as actually create a lot of pressure on the cap table from a dilution standpoint. In a down market, you have the opposite problem. It's not the cap that's the problem. It's the fact that you are getting the better of the cap or the discounted price, which is effectively full ratchet, meaning the investor today is getting the best deal that next happens. So if the company isn't going like this, it's going like this, next investor comes in and says, okay, I'm going to price this now distressed company at $1 million. The old investors all convert in at a discount to the $1 million. That's incredibly painful in that story. The other thing that they don't see coming is it used to be very market that the debt was treated like an advance. It was treated like new money at the time of the next closing. And increasingly, all of that debt, whether done as a safe, whether done as a note, doesn't really matter, is all being treated as part of the pre-money. So when next investor shows up and says, I'll give you a $5 million valuation, and they look at your cap table and they say, but wait a minute, I see that you have $2 million in bridge money on your deal, plus interest, plus discounts. So we're going to really treat your pre-money as $2.5 million, because the other $2.5 million of value is represented by those notes. So you, the existing stockholders, you're only getting a $2.5 million price. And that's a big, like, oh no, what just happened kind of moment for a lot of brands. And there's nothing you can do at the time you do the notes. You cannot prevent that. You can't say, oh, we and the note holders agree it shall be treated like X in the next round. I mean, you can say that if you want to, but next investor is the one in the position to say the condition of my money in, my next $3 million at that $5 million enterprise price, is conditioned upon the deduction of those notes from the enterprise price to get to the equity price that I'm paying, that going down to that 2.5 million. So you can't constrain that. Now you can go try and shop it and find a better deal. But right, what we're talking about is trying to find money in a really hard, difficult capital raising environment. So it's the worst of all worlds, right? You're showing up, you've got a bunch of debt on your balance sheet. It's effectively full ratchet converting. It's converting with interest and discount, and it's converting as part of the pre-money. So that's a lot of pressure on a brand. You better be growing very, very rapidly to prevent those kinds of problems. So not good news.
How can entrepreneurs and investors better communicate some of the misunderstandings around equity versus enterprise value and avoid some of the issues that may scuttle a potential deal?
Sure. Just being clear, being transparent about that communication is a great way to fix a lot of problems that happen in these deals. And so casual communication in a salesy environment, not helpful, right? If you're saying, oh, what do you think about a $4 million price? And the investor says, yes, that should not be the end of the conversation because you think, we have a deal, right? It should be, I'm thinking about a $4 million equity valuation and, you're aware that we have X million in notes on the books, right? And then if the investor says, yes, now you actually have a deal. So what you don't want is a situation where entrepreneur is thinking 4 million in equity value and investor is thinking 4 million in enterprise value, against which there's going to be a massive deduction. And that is going to substantially change the cap table at the end of the deal. So getting entrepreneurs to start thinking about things in terms of post money is very helpful. Getting clear communication about issues like the terms of those deals, those liquidation preferences, control features, dividends, just any kind of discounts, anything like that that's going to change the economics of the deal. Being clear up front so that there's good understanding of what this deal is a great way to solve a lot of problems. And for entrepreneurs who don't feel ready to have those conversations, there's great organizations that provide support. BevNet and Nosh put on great things. Other organizations in the food and beverage space in Boston, Branch Food, or the Capital Network. There's lots of nonprofits out there who provide education, and a lot of it now, which is online. So people should get educated. They should also talk to their counsel early, not after you've cut a deal, right? Where someone shows up and says, I and investor agreed on X. Can you paper it? That's a terrible conversation to have with your counsel. You should be talking to counsel and your board and your advisors to say, talking with an investor, here's what we're kind of circling around. What are the things I need to make sure I'm clear about as part of this deal before we have a quote handshake, and get that information, get that counsel up front, and then go back and sign that cocktail napkin, sign the LOI, whatever it might be, or even just shake a hand, so that you can have the best deal and you're the most informed at the time to do it.
Now, Jeremy, my last question is about the return to normal, whenever that may be and whatever that may look like. In terms of financing and capital, are there things that we should expect to return to their prior state once this is potentially resolved? Or are there, on the other side, other things which may be fundamentally changed and will no longer exist in this post-COVID landscape?
Yeah, I think the biggest unknown is what's the long-term effect of this on the strategic's appetite for buying small brands and at what prices, because that's what drives everything in this business. Most businesses are built to sell. There are still some amazing family businesses that were built to scale, not to sell, and they intended to run them as cash flow positive businesses without a lot of exterior investment that needed to monetize through a transaction downstream. Those are phenomenal. We represent some of those. Some of them are some of the biggest food businesses that people know in America. But a lot of our industry is now in the build to sell model. And so if we don't know what the buying environment looks like, that's really troubling. It was not that long ago when buyers paid 2x on net revenue, right? That wasn't even a decade ago. So you could conceivably see a lot of these brands at the strategic level, saying I need to focus on core product. I need to make sure that I've got better disaster recovery. If pandemic becomes something that people think either biological pandemic or ecological disaster, if any of these things are on their minds, then they start thinking, okay, I need to make sure that my brands are shockproof, and I need to put resources and time and money into making them shockproof. And I'm not going to spend time trying to grow 40 million brands into $400 million brand. Right, the days of Coke buying Honest Tea and having a phenomenal outcome for everybody involved may be harder to do if everyone is putting resources into risk management and into shock insulation. So they're going to really tell the story, and I think we ought to be listening to their corporate development people, their business development people, any of the folks there who are communicating about what their intentions are. That's going to tell the story, because that will drive whether there's more or less venture capital in the market. That will indicate how many brands can be supported in an environment. And similarly, you may even see things like that in the retail environment, where retailers say, lessons that were learned in this were working with small brands is hard because they can't deliver in a crisis, or maybe they can deliver better, right? So I think we're all going to learn some lessons about how the littles behave and how they can grow, and how the players in the industry that support them think about their performance during things like this.
Well, Jeremy, thank you so much for your time and insights. We really appreciate you coming on here and chatting with us. Stay safe, and we hope to talk to you again soon.
Thank you, and thanks to all my team at Nutter has been amazing, supporting our clients through this. And we have a great web portal for all things COVID and Triple P, and please take a look at that for any of the entrepreneurs out there. And thank you to BevNet and Osh for continuing to get content out and support the entrepreneurs through a difficult time. So appreciate it.
Thanks again. We really appreciate it.
Hey, thanks so much for watching. Don't forget to hit subscribe and ring that bell.